Thank you for coming back to the House of Banelord, and today we're going to have an interesting topic. We're going to discuss about a tax-free savings account versus an RSP and which one you should choose. Well, let's talk about a tax-free savings account first. I believe it was invented in 2009, and what it does is basically it allows you to have an account that is essentially tax sheltered, meaning that any investments, being dividends, capital gains, income interest, investments can appreciate without any taxation involved in it. Now, in terms of contribution, you don't actually have to make money to contribute. But every year, you get a certain set amount. I believe it starts at 5,000 and so forth. I think 2013 and 14 it was 2,500, and 2015 was 10,000, and then it went back down again. What happens is if you did not use those contributions, they accumulate. So what happens is that you could contribute quite a bit if you haven't opened one already. There is a such thing that if you over contribute, though, you do have to pay 1% penalty per month. So if you do that, you have to withdraw. Otherwise, it's going to cost you in terms of over contribution penalty. It has basically. Think about this, okay? These accounts are basically tax sheltered, okay? You have a basket, and in this basket you have any investments that normally would grow, would basically be taxable in that sense. So you can put stocks, bonds, GICs, and what have you into it. Why would you want to do this? Well, first of all, not all investments should belong to this. The reason I say that is that certain investments, like capital gains, can be outside of this. They have certain advantages. One, they're 50%. Secondly, if you lose, that's considered a capital loss. So you can use all capital loss to further capital to offset capital gains. You lose this benefit once it goes into this tax sheltered account. Secondly, dividends are already taxable at a reduced rate. Why would you want to not take advantage of that? The only time I would think, and the only time that is advantageous is to have this account, is to have specifically fixed income, GICs, bonds, anything that refers to interest. Specifically, zero strip coupons. Unless you don't know how that works, it's basically what it is that you buy an investment, and this investment strips of its coupon, so which is the interest payment. So let's say, for example, you buy something that for 10 years, and it's like $100 face value. Okay, so in 10 years, it's worth $100, but you don't pay $100. You pay, let's say, $60. Okay, and such a time as 10 years, you get $100. The only difference is that you're not getting any interest in the meantime. But the problem with that investment is that even though you're not getting interest, you're still paying interest. In terms of when taxation comes, they'll tell you how much you technically earned, and then you have to pay for that, even though you didn't get it. So that specific investment would greatly benefit in a tax-free savings account. Now, this is where it gets interesting. The tax-free savings account is use money. The money is contributed is after tax money, meaning that there's no you don't get anything out of it. Okay, so if you got a paycheck and it was like $500, and then after taxes you get $400, you deposit $400 in that account. That's it. You don't get any benefits. Nothing. It's basically used after tax money. But the advantage of that is once it comes out, there's no taxation on that. So the problem with RRSPs, imagine an RRSP is basically everything I just told you, but the reason why people get it is because, let's say you're 20 years old and you're making good money, okay? Let's say 30, whatever. And you have contribution room, and that's calculated by how much money you make. The government calculates that and tells you how much you have in terms of contribution. You take your income that's already had after withholding taxes or whatever you, and you invest it in RSP. What happens is that it reduces your marginal tax rate, and when you do your income tax, because your marginal tax rate is reduced, because a chunk of it is contribute, you technically pay less taxes. That is true, and that is actually very advantageous. But the problem with that is once you get older, the theory behind this: once you retire, you should be at a lower tax bracket because you're making limited means, right? And so the money that comes out, it will have to be converted into a RIF, by the way, registered investment fund or whatever it is, and it has to be automatic withdrawal, okay, and that is tax, okay. So then you get taxed afterwards. Problem with that is you don't know what the tax laws will be by the time you retire. It could be higher, it could be lower. We don't know. This is basically what the government says it is, okay. Whereas TFSA, there's no tax on that because you already paid it. It's with pre-tax money, okay? I mean, post-tax money. Do I see, which one do you think is better? I honestly think the TFSA is better, whereas the RRSP is an old product. It was designed for people to retire, okay? That's what it was designed for. It gives them an incentive to retire. But this product, the TFSA, has taken over. It was invented in 2009, and it's a better product. Okay, that is something that you should invest in. No, something you should open. It doesn't cost anything really, and then just put all your fixed income in that tax shelter account. When you're young, you have time for this money to grow, time for it to accumulate tax-free. And imagine that. Imagine this, okay? Imagine money that is growing in that account that is not taxable. So basically money growing upon money growing upon money. That's exactly what it is. So if you haven't opened one, just go ahead and do it, okay? Open one, you could just put regular savings, your savings account, regular contributions to it until such time that you decide you want to invest in something better. So that's my take on tax-free savings account. Not good for securities like stocks, really good for fixed income securities. Thank you.